Greetings, it's me, Dr. Paul Gerhardt, and this is video number 5 of our Acquisitions and Mergers series of videos. Welcome to Module 5. In this lecture, we'll examine leverage buyouts, going private, and private equity. These topics combine finance, strategy, governance, operations, and stakeholder responsibility. The central idea for this module is simple, but important. Debt can increase an investor's return, but debt does not create operating value by itself. A company still has to serve customers, retain capable employees, invest in its future, generate cash, and remain resilient when conditions become difficult. By the end of this lecture, you should be able to define private equity and its major dimensions, explain the potential benefits and costs of leveraged buyouts to stakeholders, and identify why private equity firms find some businesses more attractive than others. As managers, you may encounter private equity as an employee, executive, board member, seller, lender, advisor, customer, or community stakeholder. Understanding how these transactions work helps you evaluate not only whether a deal can be financed, but whether it can create sustainable value. So let's get started. What is private equity? Private equity refers to privately negotiated ownership investments in companies or assets. It includes buyouts, growth equity, venture capital, distressed investing, and special situations. In this module, our main focus is the buyout side of private equity. A private equity firm usually raises a fund from outside investors called limited partners. These investors may include pension funds, endowments, foundations, insurance companies, sovereign wealth funds, and family offices. The private equity firm acts as the general partner. It selects investments, works with lenders, governs portfolio companies, and eventually seeks an exit. A portfolio company is simply a company owned or controlled by the private equity fund. The sponsor generally does not expect to own that company forever. The investment is usually made with a plan to improve the company, increase its value, and sell or refinance it within the fund's time horizon. This matters to managers because fund structure influences behavior. Management fees support sponsors' operations. Carried interest gives the sponsor a share of investment profits. Fund life creates pressure to invest capital, improve companies, and eventually exit. These incentives can produce discipline and urgency, but they can also encourage overpayment, excessive risk, or decisions focused too heavily on exit timing. Now, what is a leveraged buyout? A leveraged buyout, commonly called an LBO, is an acquisition financed with a substantial amount of debt. The sponsor contributes equity, arranges financing, acquires control of the target company, and expects the acquired company's future cash flow to support the debt. The acquired company must continue paying employees and suppliers, serving customers, investing in equipment and systems, and meeting legal and regulatory obligations. At the same time, it must make interest and principal payments. That added financial burden is why cash flow quality is so important in an LBO. The sponsor's equity is junior to the debt. This means the sponsor receives the residual value after lenders are repaid, but it also means the sponsor's equity absorbs losses first. Lenders receive contractual payments and priority claims, although they usually do not receive the same upside as the owners. For managers, the key lesson is that an LBO is not merely a purchase funded with borrowed money. It is an ownership and governance model built around cash flow, financial discipline, operating improvements, and an eventual exit. Now let's talk about sources, uses, and the basic LBO structure. Every LBO begins with a sources and uses analysis. The uses side identifies what must be funded. This can include the purchase of the seller's equity, repayment of existing debt, transaction fees, and the cash the company needs at closing. The sources side identifies where the money will come from. A transaction might use a senior secured loan, a revolving credit facility, junior debt, and sponsor equity. The sources must equal the uses. For example, imagine a transaction requiring $920 million. Financing might include $430 million of senior secured debt, $20 million from a revolver, $100 million of junior debt, and $370 million of sponsored and co-invested equity. That schedule may balance perfectly, but balance does not prove that transactions are safe. Managers must still ask whether the company can pay interest, invest in working capital, fund necessary capital expenditures, pay taxes, withstand a downturn, and refinance debt when it matters. The managerial question is not simply, can lenders fund this deal? The better question is, can the company support this capital structure while remaining healthy? So let's talk about why leverage magnifies gains and losses. Leverage allows an investor to control a large company with smaller equity contribution. When the company performs well, that can increase the return on the sponsor's equity. When the company performs poorly, leverage can cause equity value to fall very quickly. Suppose a sponsor buys a company for $1 billion using $400 million of equity and $600 million of debt. 5 years later, the company is worth $1.3 billion and debt has declined $350 million. The equity value is now $950 million. The original $400 million equity investment has grown to 2.38 times its original size before fees and taxes. Now consider the downside. Suppose the company is worth only $700 million and still owes $550 million. Equity value falls to $150 million. Suppose the sponsor has lost 62.5% of the original equity investment. This example shows why leverage is powerful. It can change how gains and losses are divided between lenders and owners. It does not create customers, strengthen a brand, improve quality, or make employees more productive. Those outcomes require real managerial operating work. So, how do LBOs create value? Private equity returns usually come from 5 sources. First, the company may increase EBITDA through revenue growth, improved pricing, better productivity, or stronger margins. Second, the company may use free cash flow to repay debt. As debt declines, more of the company's value belongs to equity owners. Third, the sponsor may sell the company at a higher valuation multiple than it paid. This is called multiple expansion. Fourth, the sponsor may reposition the business through acquisitions, divestitures, improved governance, and new capability for a clearer strategy. And fifth, the sponsor may receive cash distributions before the final exit, including through a recapitalization. The most important source of value are usually genuine operating improvement and debt paydown supported by real free cash flow. Multiple expansion is less controllable because it depends on interest rates, market conditions, buyer competition, and timing. For managers, a strong investment thesis could remain credible even if the company is sold at the same valuation multiple at which it was purchased. If the entire return depends on finding a more optimistic buyer, the plan may be financially fragile. So let's talk about what EBITDA is. It's not cash flow. EBITDA means earnings before interest, taxes, depreciation, and amortization. It's widely used because it helps investors compare operating performance across companies and capital structures. However, EBITDA is not the same as cash available to pay debt. It does not subtract interest expense, cash taxes, capital expenditures, working capital investment, restructuring costs, pension contributions, leases, litigation costs, and other obligations. A company can report strong EBITDA and still experience a cash shortage. This becomes especially dangerous when a sponsor uses adjusted EBITDA that includes expected cost savings, projected synergies, or expenses described as non-reoccurring. Managers should use 4 questions about every adjustment. Has the improvement already occurred? What will it cost to achieve? How long will it take? And could it damage revenue, service quality, employee capability, or customer relationships? The practical lesson is that debt capacity should be based on how realistic cash flow and downside liquidity, not an optimistic EBITDA number. Okay, now let's talk about financing and debt capacity. An LBO may use several types of financing. Senior secured loans have priority claims and collateral. They often include variable interest rates, required reporting, covenants, and scheduled repayments. High-yield bonds may offer long maturities and fewer maintenance covenants, but they generally carry higher interest. Mezzanine debt is junior to senior debt and may include equity participation. Private credit and unitrans loans can provide speed, confidentiality, customized terms, although they may be expensive and give a concentrated lender significant influence. Covenants are contractual protections for lenders. They may limit leverage, additional borrowing, asset sales, acquisitions, dividends, or sponsor payments. Some covenants are tested regularly. Others apply only when the company wants to take a particular action. Covenant-light financing can give a borrower more flexibility and delay a technical default. It does not eliminate economic risk. In some cases, fewer covenants simply mean that lenders intervene later and the company's financial condition has deteriorated further. Managers should stress test debt capacity. What happens if revenue falls? What if margins decline? What if interest rates rise? What if major customers leave? What if inventory or receivables absorb cash? What if refinancing markets are closed when debt matures? The most responsible approach is to size debt for the difficult but plausible operating period, not the company's strongest recent year. Okay, so let's focus on going private and management conflicts. A public company may go private to reduce reporting burdens, permit longer-term restructuring, concentrate ownership, address perceived undervaluation, or strengthen management incentives. Private ownership can create more strategic flexibility, but it also reduces public liquidity and transparency. Management buyouts require special attention because executives may influence forecasts, access to information, bidder cooperation, and their own future employment or ownership. Managers may know information that is not fully reflected in the market price. They may also prefer a bidder offering the most attractive compensation or rollover equity. A fair process should use genuinely independent directors, independent legal and financial advisors, complete access to forecasts, serious considerations or alternatives, and clear documentation of negotiations and conflicts. In appropriate cases, approval of unaffiliated shareholders may also strengthen the process. The managerial lesson is that disclosure alone does not make a transaction fair. Fairness depends on independence, reliable information, genuine negotiation, and the power to reject the deal. So, why do some businesses attract private equity? Great question. Private equity firms do not simply look for companies that can borrow. They look for businesses that can support debt, improve over time, and remain valuable at exit. Stable and predictable cash flow is attractive because debt must be paid in both strong and weak markets. Reoccurring revenue, high customer retention, diversified customers, essential products, and limited cyclicality can also provide downside protection. A defensible market position is also important. Brand strength, switching costs, regulatory licenses, proprietary technology, data advantages, distribution strengths, and niche leadership can protect margins and cash flow. Manageable capital requirements matter because a company must convert earnings into cash. An asset-light business may do this more easily, but managers must be careful not to confuse temporary underinvestment with low capital needs. Maintenance spending cannot be ignored forever. Private equity firms also look for credible improvement opportunities. These may include better pricing, stronger sales execution, procurement savings, working capital improvement, digital systems, management development, and reduced complexity. Excuse me. Fragmented industries may support a buy and build strategy. The sponsor acquires a platform company and then adds smaller businesses. This can create scale, broader services, purchasing power, and geographic reach. It can also create integration failures, cultural conflict, service problems, overpayment, and anti-risk trust. Finally, entry price matters. A strong company can be a poor investment if the sponsor pays too much. Overpayment forces the plan to depend on aggressive growth, heavy leverage, or a favorable exit multiple. Okay, now let's talk about benefits and costs to stakeholders. Private equity ownership is not automatically good or bad. Its effects depends on the company purchase price, leverage, sponsored conduct, governance, and value creation plan. Sellers and shareholders may receive a premium, liquidity and solution to ownership, or succession concerns. They may also give up future upside or face conflicts in sale processes. The portfolio company may receive focused ownership, faster decision-making, access to capital, stronger incentives, and operating expertise. At the same time, high debt can reduce flexibility and make the company more vulnerable during a downturn. Employees may benefit from growth, new systems, professional development, clearer accountability, or equity incentives. They may also face layoffs, benefit reductions, increased performance pressure, cultural disruption, or financial distress caused by excessive leverage. Creditors and suppliers may gain new business and contractual returns, but they also face default risk, payment pressure, or weaker protections. Customers and communities may benefit from investment and improved service, but they may also experience closures, reduced access, higher prices, lower staffing, and declining quality. Managers should identify who receives each benefit, who bears each risk, and who controls the decision. A transaction can create value for owners while shifting significant costs to people who did not choose the capital structure. All right, briefly, let's focus on dividend recapitalizations. A dividend recapitalization occurs when a portfolio company borrows additional money and distributes proceeds to its owners. This can allow the sponsor to recover part of the investment before the final exit. The concern is that companies receive no new product asset in exchange for the additional debt. It simply becomes more leveraged. When the transaction complies with loan covenants, it may reduce the company's ability to invest, make acquisitions, absorb a downturn, or respond to an unexpected event. Managers should not treat covenant compliance as proof that the recapitalization is prudent. The key question is whether the company remains resilient after the distribution and whether the sponsor's liquidity is being created at the expense of the portfolio company's long-term health. Great. So, managers really must understand governing and improving the company portfolio. After an acquisition closes, sponsors often use a 100-day plan. The purpose is to establish priorities quickly without confusing urgent stabilization with long-term transformation. The early plan should clarify leadership roles and decision rights, establish reliable financial and operating dashboards, protect important customers and employees, examine liquidity and capital needs, and launch a limited number of high-priority initiatives. Private equity boards are often smaller and more active than company boards. They may review monthly operating performance, cash flow covenants, acquisitions, leadership changes, and exit readiness. Concentrated governance can improve speed and accountability, but it can also magnify sponsor conflicts if the board ignores the portfolio's company's independent interests. Managers should distinguish operational improvement from financial engineering. Operational improvements change how the company creates value. It includes revenue growth, pricing, productivity, quality, systems, and working capital, acquisitions, and stronger leadership. Financial engineering changes capital structure, taxes, timing, or distributions. Both can influence returns. However, operational improvement is more sustainable because it leaves behind a stronger business. Now, here's something to think about related to monitoring the investment thesis. A sponsor should continuously compare actual performance with the assumptions used to justify the acquisition. That includes revenue, margins, EBITDA, cash flow, customer retention, employee turnover, capitalized expenditures, liquidity, covenant cushion, add-on integration, and return on invested capital. In stakeholder-sensitive industries, managers should also track safety, staffing, access, compliance, and service quality. Financial improvement is not sustainable if it depends on hidden deterioration in the product or service. A disciplined sponsor should identify in advance what evidence would invalidate the original thesis. Managers should be willing to revise the plan when customer behavior, operating results, competitive conditions, or integration outcomes contradict the assumptions made at closing. All right, but what about exits and return measurement? Private equity sponsors eventually seek an exit. A strategic sale may produce a high price when the buyer expects synergies. A secondary buyout transfers the company to another sponsor. An initial public offering can create staged liquidity but requires public company readiness. A continuation fund may allow a stronger holding period, although it creates important valuation and conflict concerns. Two common return measures are IRR and MOIC. MOIC means multiple on invested capital. If a $200 million equity investment returns $500 million, the MOIC is 2.5 times. The IRR is sensitive to timing, receiving $500 million after 3 years producing a higher IRR than receiving the same amount after 7 years. This is why early distributions can improve IRR even when they do not prove that the company has become a stronger business. Managers and investors should interpret IRR and MOIC together. They should also consider leverage, risk, interim distributions, fees, carried interest, and whether the value creation can survive after the sponsor exits. Now, let's discuss why LBOs fail. LBOs usually fail because several problems reinforce one another. The sponsor may pay too much, overestimate EBITDA, use too much debt, underestimate capital needs, or rely on favorable financing and exit markets. An economic downturn, customer loss, technological disruption, weak management, or failed acquisition, integration can then expose those weaknesses. A typical downside spiral begins with declining revenue or margins. Cash flow weakens. Covenant cushion disappears. Management cuts investment to preserve liquidity. Service innovation or employee capability deteriorates. Performance declines further, and lenders demand concessions or restructuring. Leverage reduces the time available to correct strategic mistakes because fixed payments continue while recovery makes effort take time. In distress, equity may be severely impaired or eliminate even when the company continues operating. The managerial lesson is that the downside resilience must be designed before the transaction closes. It cannot be added easily after the company is already under financial pressure. A managerial framework for evaluating an LBO. When evaluating an LBO candidate, managers can use the following sequence. First, assess the industry, competitive position, and sources of customer value. Second, normalize EBITDA carefully and convert it into realistic cash flow. Third, estimate how much debt the company can support under downside conditions. Fourth, identify operational and strategic improvements that are specific, measurable, and achievable. Fifth, evaluate management capability, incentives, and leadership gaps. 6. Assess acquisitions, separation, technology, and integration complexity. 7. Determine a disciplined entry valuation. 8. Identify several credible exit alternatives. 9th, evaluate effects on employees, creditors, customers, communities, and regulators. 10th, test the expected return without assuming multiple expansion or perfect execution. This framework helps managers move beyond the question of whether a deal can close. It asks whether a company can perform, invest, adapt, and create value after closing. Let us review the central ideas of this module. Private equity is more than a source of money. It's an ownership and investment system connecting sponsors, limited partners, lenders, managers, portfolio companies, and exit markets. An LBO uses substantial debt to acquire a company. Leverage magnifies gains and losses, but it does not create operating value. The strongest return drivers are sustainable EBITDA growth, real free cash flow, debt paydown, strategic improvement, and disciplined governance. Multiple expansion may help, but a sound thesis should not depend on it. EBITDA is not cash flow. Managers must account for interest, taxes, working capital, capital expenditures, and other obligations before deciding how much debt a company can support. Attractive private targets usually have predictable cash flow, defensible market positions, manageable capital requirements, capable management, credible improvement opportunities, disciplined entry prices, and several possible exits. Private equity can provide focus, capital incentives, expertise, and governance discipline. It can also create financial distress, underinvestment, workforce disruption, stakeholder harm, and conflicts of interest. The strongest LBO thesis remains viable under downside conditions and does not require perfect execution, permanently open credit markets, or more optimistic buyer at exit. Leveraged buyouts and private equity requires managers to connect financial decisions with operating reality. Debt may make an acquisition possible and may improve equity returns, but the company still has to generate cash, serve stakeholders, invest in capabilities, and survive difficult periods. The central managerial responsibility is therefore not to maximize leverage. It's to match debt with sustainable cash flow, preserve flexibility, and create value through a stronger business. A financially successful exit is most defensible when it results from better operations, responsible governance, capable leadership, durable customer value, and cash flow that remains healthy after the sponsor leaves. This has been a lot of information about leverage buyouts and private equity. I hope that you have learned something and you're taking away something that you can use. And more importantly, I hope that you have a great day because only you get to choose how you feel about it. I'm Dr. Paul Gerhardt.